Hi everyone, I'm Shabri Moore, founding partner of Moore Wealth. We are a financial planning and wealth management firm headquartered in Frederick, Maryland. Today I'd like to talk about timing the market. Actually, I'd like to talk about strategies you can use to avoid market timing. It is very tempting to sell when you see that markets are plunging and your portfolio is dropping in value. By the same token, it is also very tempting to buy when markets are surging. We call this FOMO, or fear of missing out. The reality is that trying to figure out what to do when markets are going up or markets are going down, and especially in times of volatility as we have now, is truly a fruitless task. Aside from the harm that this can do to your portfolio, it creates an awful lot of stress. In today's video, I'd like to share with you 4 strategies you can use to avoid trying to time the market. Number 1, stay on track with your financial plan and your investment strategy that you've developed, hopefully, for the long term. It's really tempting to buy and sell when you see that markets are fluctuating. The idea, of course, with that is to take advantage of potential market inefficiencies. However, we know from history and also from multiple research studies that a financial plan that really works is one that is built on discipline and looking at your personal risk tolerance, your personal time frame, and your personal goals. Sticking with those strategies will allow you to see growth in your portfolio as well as help you meet your overall long-term goals. Number 2, understand that if you plan to time the market, you need to be right twice. First, you need to know exactly when to get out of the market, at the peak, of course, so that you're maximizing the profits that you're seeing. You also need to know exactly when to get back in. And of course, that's going to be at the very bottom of the market when you're buying low. That whole concept of sell high and buy low. For those of you who've been in our office, we keep this crystal ball on our conference room table. It still doesn't work, by the way. As soon as we can get it to work, we can help you with figuring out when the high is and when the low is. Bottom line is, a disciplined strategy is a far better way of investing than trying to figure out when the market is at its peak or when it is at its bottom. Number 3, invest on a regular schedule. Set a certain amount of money that you plan to put away on a particular time frame. A great example of this is a 401k, a 403b, or any similar type of employer-sponsored retirement plan. You have a certain amount of dollars that are invested every pay period. Every pay period, that set amount is set aside for you and invested. You don't have to think about it, and you don't have to worry about, am I getting in at exactly the right time? We call this dollar cost averaging, and it's a strategy that has worked very, very well over the years. You can add this, or better yet, complement it by investing a set dollar amount into a brokerage account outside of your employer's plan. Now you've got 2 different automatic investment strategies. And finally, reach out to your financial advisor. Being cognizant and aware about not going in and out of the market frequently or trying to time the market doesn't mean that you should be silent if you have concerns about your portfolio. If you have questions or feel that there's some discussion needed, reach out to your financial professional and ask their advice on what you should be doing. The 2 of you are partners, after all, in building your financial portfolio and your overall financial plan. By working together, you can avoid making emotional decisions and trying to time the market. Thanks so much for listening today. You can reach me at 301-631-1207 and get more information about our firm at www.morewealthinc.com. Click subscribe to follow our videos and follow us on social media by using the links below. Until next time.